and welcome to a very special Indianomics. Special because the Indian economy has grown by an unexpected scorching 7.6% in the second quarter. In our entire range of expectations, when we did the poll, there was no one who gave us a 7.6% number. As you can see, the CNBC TV18 poll was 7.03%. But the Reserve Bank, in its forecast 2 months ago, had only given of 6.5%. So this is clearly blistering. Now, what were the internals? It was only agriculture that was a little under the weather at 1.2%. Our poll was about 2.5% for agriculture. But the surprising part was that manufacturing and industry contributed maximum. Look at the double-digit growth. Mining 10%, manufacturing 13.9%. I can't remember when I last saw a number like that, maybe 2004 to 2008. Electricity and other utilities 10% and construction 13.3%. Surprisingly, India's services sector economy actually didn't show up much in terms of services. Trade hotels just 4.3%. That's a very big sector in terms of employment. Finance 6% and public administration 7.6%. Another perhaps not so cheerful number is when you looked at GDP from the demand side, then a private final consumption expenditure grew by only 3.1%. It was capital formation, which was at 12.4%, and government consumption at over 11%, which brought home such a big GDP number. Joining me to analyze the GDP numbers and to tell us whether the full year GDP numbers have to be revised sharply are three prominent economists: Shubhada Rao, the founder of QuantEco Research; Nikhil Gupta, the chief economist from Motilal Oswal Financial Services; and Anubhuti, Sahay, the chief economist from Standard Chartered. She heads research for South Asia at StanChart. Ladies and Nikhil, thank you very much indeed for joining me. Well, Shubhada, since you are the senior most, this question to you. Does it feel like 2004 to 2008? Do we have to radically revise our expectations, at least in the near term, from the economy?
I think I'll take the last one first, Latha. Thanks for calling me here. I think we are in for a fair amount of revision for GDP because it has pleasantly shocked us by almost 110 basis points compared to our forecast. So clearly we are looking at a likelihood of a 6.5% plus for the full year GDP. And going to your earlier question, I think, does it look like a 2004, 2005 kind of a scenario? I think I would like to look at it from two halves a year. The first half gone by, which has shown a solid growth of 7.7%. It's the second half, which I would look at slightly bit more cautiously. Agriculture, led by a fair number of headwinds. The government capex, which was a strong, heavy lifting driver of growth, would start waning, in our opinion. Aggregate support would be great, but incrementally the support would start declining. The discretionary demand from the urban side would start looking on the lower side. Net exports would continue to drag. So all in all, I think H2 would be a slightly sober number. And that's why we are not really significantly revising it close to 7% for the full year as a whole.
Fair point. I take your point about your worries over consumption because the private final consumption expenditure has come in only at 3.1%. And yes, the fiscal numbers came out. Government capex in October 23 is 17% lower than what it was in October 22. Perhaps it's a one-off, but clearly the government may have to reduce support. Nikhil, to you on that point. I think like most others, the forecast, a large number of the forecasts came between 6.5 and 7%. Do you think, Nikhil, we need to revise up our full year numbers?
Thank you, Latha. Yes, Latha, the number was impressive. Not only the headline numbers, but the details are also as impressive. The first point is 7.6% headline number is much better than the highest forecast that was there on the street. We all know that. But the driver of this growth were also something that we need to be, that was really special. It was not consumption, it was investments. And within investments, we know for the last 2 quarters, corporate investments have declined. And we were expecting another decline in Q2, but corporate investments have actually increased in Q2. Despite higher corporate investments, now I have always been worried about if corporate investments pick up, we could see higher CAD because financial savings has fallen, but that did not happen. Net imports of goods and services was only 2.4% of GDP in Q2 vis-a-vis 2.3% in Q1, precisely because consumption growth was weak. Because of weak consumption growth, it is very likely that household financial savings picked up a little in first half vis-a-vis FY23. So the internals, be it corporate investments, financial savings, it all was probably a picture perfect, as I would want to call it. Definitely not expected. As far as revisions are concerned, definitely we were at 6.2% for the full year. Because of Q2, we will be revising it up once again to 6.5 or 6.6%, but we still do not see it to be, it will be in line with what the RBI was expecting, which was very optimistic vis-a-vis the market forecast. I think RBI will not be revising it significantly, but the market, the private forecasters, I will be revising it upwards towards the RBI forecast for this year.
Okay, towards 6.5%. Let's see. We will know whether the Reserve Bank will choose to, increase it. We will know it on December 8. Now, Anubhuti Sahay, welcome. You're the person who came closest to the number, actually. You gave us a 7.2% number. That's the highest of all the readings that I got when I did my poll. But it's better than the best, the most optimistic estimate. What surprised for you? I mean, how does one explain a 13.9% manufacturing? It just doesn't seem like we got any wind of it, even if we look at the IIP numbers. The IIP numbers, July, August, September is 7.4% average. This really is a bolt from the blue. How do you explain it?
So, Latha, I would just, flag three reasons why probably we got this upside surprise. First is the corporate earnings. Most of the analysts like me, we look at a smaller sample. RBI, just before the GDP number, came out with its study and data on the performance of non-financial private sector. And if you look at the EBITDA growth, which goes into the manufacturing sector calculation on GDP, that EBITDA growth was at 25%. This was in low single digits in Q1. We were building in a strong EBITDA growth, but definitely not at 25%. So that has clearly played a very important role. And if I look at the underlying factor, which probably pushed up the EBITDA growth at such strong levels, it's probably driven by very well contained commodity prices. The second part is, industry. If we look at the industry as a whole, it was a dry season for sure, but again, construction was much better, 13.3%.
Yes.
We were expecting a 9% growth. So, that was another factor which clearly surprised us on the higher side. Now, on your question, which you have asked Nikhil as well as Shubhada, can these factors continue in the quarter 3 and quarter 4? I think the support from low commodity prices, I think that is something which we probably will have to start building in. That will continue to keep the EBITDA growth at a stronger level and probably can keep the manufacturing sector look better than what all of us are building in at this particular point in time. But the support, which has come because of a dry season, should start fading from Q3 onwards. Okay. So overall, if I look at it purely from the number perspective, our GDP growth number for full year is at 6.5%. Can it be marginally higher? Yes. But some of the support factors, as Shubhada pointed out, and as the dry season impact fades away, our senses, H2 can be much more moderate than H1, but probably not as slow as we are building in at this particular point.
So you will go to 6.5 at least, you think?
We are already at 6.5. Okay. Maybe we see, like a 10, 20 basis points upside risk to this number. Okay. Given that the support from commodity prices, and even if we look at our composite indicator, the momentum still remains strong in the month of October. Okay.
Nikhil, would you bet heavily now on the capex stories in the economy? Capex seems to be very strong. The government's April-October capex is 33% higher than what it was a year ago. But, is there more to go? I'm only worried because consumption has not picked up so much. So you can't keep on creating capacity when consumption is lagging a bit. And secondly, this trade hotel services, it's the biggest employment generation vertical. And that's just 4.3%. So the short question, should we continue to back capex stories? Do they still have a good run?
That I'm not very optimistic. Yes, Q2 was much better, but whether these numbers will sustain, I don't think so. I don't believe that overall investment rate in India is going to pick up to 32 or 33%, let alone at the peak of 37, 38%. I still believe for the full year and in FY25 as well, it will remain somewhere around 30, 31%. Because we know that the center's capex has been very strong. The state's capex has been very strong in the first half, but second half could be a different story because of the base effect and because of the fact that we have elections, so the revenue spending also has to grow decently. I do not see any reason. I do not have any confidence that the government will be able to maintain 25-30% kind of growth in FY25 if they are serious about their fiscal deficit target, which must reduce by 60 to 70 bips next year. At best, they can do 15% kind of growth, which would be very moderate vis-a-vis the last 2 to 3 years. And it would be broadly slightly better than the nominal GDP growth for the next year. So I'm still not counting in the revival in corporate capex. I am very sure that government capex will weaken vis-a-vis the last 2-3 years in FY25. So no, I'm still not gung-ho about the capex recovery that we have heard in the last 2 years. And Q2 data was very strong, but still no.
Okay. Very quickly, Shubhada, do you think the Reserve Bank will therefore continue to remain tight in its policy simply because growth is so good that they may want to lean on the other side? Is that likely?
Yeah, I think RBI is going to continue with its focus on liquidity management. Could it tweak rates or corridor is a matter of opinion. Whether we see, what kind of a tweaking in language does RBI bring in the forthcoming policy on 8th. But we believe that the liquidity focus of keeping it tight and the stance of withdrawal of accommodation would continue for some time, and any rate cut hopes that were perhaps getting built in, we were of a view that it would start in Q2 of the next fiscal year. We would need to assess what inflation story, what growth story plays out over the next 2 quarters.
Well, I have to take a break, but I want one rapid fire with all three of you. So please give me monosyllabic answers. Anubhuti, full year number likely to be GDP growth?
6.5 is the current forecast, marginal upside risk.
Nikhil?
We will be revising it up to 6.5 to 6.6%.
Shubhada?
6.5 to 6.6.
Okay, so everybody is going a step ahead of the RBI number, which was already considered very strong. Very quickly, Anubhuti, rate cut expectation pushed to?
No, it's still at June 24. We expect rate cuts to start from June 24, 50 bips only
Nikhil?
in the full cutting cycle.
No, we have not penciled in any rate cut for the next 3 to 4 quarters. We do not change that.
So, Shubhada?
End of Q2, early Q3.
Okay, all right. Have to take a quick break, coming back with more questions on how government policy may change and whether consumption is something which we have to worry about. Also, more on what we should expect from the Reserve Bank after this break.